Well, good evening, everyone. Today we shall be revising financial accounts, preparing financial statements. It's a good start for the level 3. Last week we had a look at the first part of task 1, which is all to do with non-current assets, and we started completing a non-current asset register. Tonight we're going to look at depreciation, which is how we use up the value of an asset, how we match the loss in value of an asset over the useful life of the asset rather than charging the whole cost of it in one hit at the start. And we'll be also looking at what we do when we dispose of an asset, both in terms of how this is recorded in the asset register and also how we do the calculations for whether we've actually made a gain or a loss. So without further ado, depreciation. This task will test how well you understand depreciation. There are two methods, generally speaking, that we meet. Straight line depreciation, which is the cost minus any residual value over the useful economic life of the asset. The reason we call it straight line is that if we did a graph of how much the asset is worth, let's say we were going to buy an asset for £7,000, and let's say that we were going to keep it for 4 years, after which time we were going to sell it, let's say, for £1,000. Then over a 4-year period, it's going to go down in value an equal amount each year, which will give us a straight line. So the amount each year, it's going to drop from 7,000 to 1,000, which is 6,000, and of course 4 years. Each year it'll drop in value by £1,500. And as we draw this on a graph, sure enough, we'll get a straight line. I'm not the world's greatest artist. This isn't bad for me, this. So straight line. Our other method is reducing balance depreciation, or diminishing balance. With this, the charge each year, rather than being the same and giving us a straight line graph, the charge each year will reduce. And this is because each year we will reduce the asset by a particular percentage of its current value. And in this case, if we bought the same asset for £7,000, it's not the most friendly figure. If we said that we were going to depreciate at 20% reducing balance, year 1, 7,000 cost times 20%, that's going to be £1,400. Well, it's going to be about there. At the end of year 1, it's going to be worth £1,400. It's going to be worth £5,600, which is about what that is. Year 2, £5,600 times 20%. So it's going to go down. What's that then? 1,120. I should do it in my head, but it's late. At the end of that year, the value goes down again to what's that, 4,480? Yeah. So this year it's gone down in value again, but not as much. We'll just do year 3. if if my pen will let me. 480 times 20%, 896. So each year the amount we're charging diminishes. So 4480 plus 896. 3584. So we're still actually over half the value after 3 years. This graph doesn't really show it, but what's going to happen is we're going to have a curve. Useful bit of exam technique here. We get a mention in with straight line depreciation. There is a mention of the residual value, because step one is to work out how far the value will drop. Step two is to share that over the years. With reducing balance, there is no need to know the residual value, because the asset is going down at a set percentage of the net realizable value of its net book value, the net book value at the end of the previous year. So there is nowhere in the calculation to use the residual value. So generally speaking, if you are given a cost and a residual value and you're not told what method to use, that suggests you should be using straight line. Okay, so that's the mechanics of how we calculate depreciation. When we dispose of an asset, we have to eliminate all of the entries relating to that asset from the books of account, because our books regarding non-current assets are there to tell us what value of non-current assets we currently hold, how much they have depreciated to date. And once we've disposed of them, we don't have them anymore, so they have to come out. And I like to think of the metaphor: we have a delivery van, we're disposing of it, it goes out of the car park and is gone from the business. By the same token, the figures relating to that delivery van go out of the ledger accounts and out of the business. If you picture in mind that that asset has gone from the business, then it makes sense that all of the entries that record that asset are gone from the business. And a useful tip here, as a way of getting your debits and credits always the right way around, is to stack up your workings vertically. Now, if we buy an asset, let's say it's this delivery van that we've been talking about, and let's say that we have, when we bought it, we paid £10,000 for it. It's an asset, so the cost of the asset is recorded as a debit. The only rule we ever have to learn in double entry: an asset is a debit. Over the period of its life, we have posted depreciation, and let's say we've depreciated it for 3 years out of an expected 5-year life. 10 over 5 is 2,000 a year, abbreviating. So over 3 years we've owned it, we've depreciated by 6,000. And at a glance, we can see that if somebody said, what's that van written down to? We can see that with 10 one side, 6 the other. So we know that it has a net book value of £4,000. When we dispose of our van, we are going to move it out. The way we move it out of the books is into the disposal account. Disposal account is a bit like the exit to the car park that it's going to be driven out of when it moves away. And for neatness, we'll change colour. So we've got to remove the cost of that van, because however long we've owned it, the cost is still what it cost us. That's got to go out of cost to leave no cost behind. For every credit, there must be a debit. That's gone to disposal. Likewise, the accumulated depreciation keeps a track. That account keeps a track of the depreciation that has accumulated to date on all of the assets we still own. We don't own this one anymore because it's gone. So to clear a credit down to zero, we post a debit. For a debit, there must be a credit. And we've now just transferred the £4,000 value of that asset into the disposal account. Now, the chances are we haven't given it away. We've probably sold it. It might be that we have received a part exchange. It might be we've sold it for money. Let's say that for whatever reason, we had one more delivery van than we needed. We've simply sold it. When we sell something, people will give us money. What do we do with money? We put it in the bank. Let's say that we've received £3,000 for the sale of our used van. We've not looked after it very well. It's a bit battered. It's gone down in value a bit more than we thought. We put £3,500 in the bank. We've received £3,500 from the disposal. So the story that this little set of accounts tells us now, we no longer have this asset. We no longer have any record of any depreciation relating to this asset. We have a disposals account that we'll come back to in a minute. We've got £3,500 in the bank. Now, the disposal account, like all accounts that depict activity during the year, income, expenditure, purchases, sales, has to be cleared down at the end of the year. And we can see that at the moment, there is an imbalance between the sides. Now, at the end of the year, where does all of our activity go? It all goes into the statement of profit or loss. And our final job is to record that we've either sold this asset for more than we had written it down to and made a gain, or we have sold it for less than we've written it down to and therefore made a loss. And the way we find that out, with £10,000 on the debit side, if we balance off the disposals account, £9,500 on the credit side, we need to add in 500 on the credit side to make it all balance to 10. That means we're going to enter the complementary debit to the statement of profit or loss. We bought a van for £10,000. We depreciated it by 6. That meant it was worth 4. We sold it for 3,500, so we lost 500, and there is a 500 expense debit to statement of profit or loss. And that's how it works. But the key takeaway, hopefully, from thank you, Zara, yes, 500, excellent. The takeaway from this is if you stack up all of your workings vertically like that, it becomes very easy to spot that I'm going to debit here and credit here. I'm going to credit here and debit here. You won't make the mistake of doing 2 debits or 2 credits, which sounds ridiculous, because when you see it laid out like this, you think, how could you ever do that? But we do. That is something that we do traditionally get wrong. So let's now have a look at first part of tonight's exercise. This is a typically piece of an exam question. I've actually taken the second part of this first, because the other bit is about a disposal in a moment. So Crithens and Son is not VAT registered. Now this makes a difference, because any asset that we buy, our supplier is going to expect us to hand over a lump of VAT as well as the cost of the asset. If we are VAT registered, we can usually claim back the VAT, and therefore we only need to record the net value of the asset as our cost, because we're not paying that VAT. We'll hand it over the one hand and claim it back from HMRC with the other. But it's a company car, and that makes a difference anyway. So the cost of the car, £12,000, but we are paying in addition to that VAT of 2,400. So we are going to part with £14,400. Thank you, Michaela. Absolutely. And the whole of that is going to be our cost. Now, as an aside, even if the company is VAT registered, special rules apply to company cars. The gist of which is, if there is any personal use, so if they say we've bought a new company car for the sales manager, and as well as visiting clients, he's going to go off home at the weekends and use it for his shopping and go away to holiday with it. If there's any personal use, as a general rule, the VAT is not reclaimable, whether the business is VAT registered or not. So do watch out for cars. But if it's a van is okay. You can claim the VAT back on a van, whatever you do with it. There are exceptions to the VAT on cars, as I recall. Anybody who's really mustered on VAT. Driving school, if you are offering driving lessons, so you've got those white and great signs on top of your car and L plates all over, you're allowed to use that for personal use. You can still get your VAT back. Hire cars, I think if it's if it's a taxi, and yeah, and hire cars. So generally speaking, watch out for if they say it's a company car for a member of staff, which it usually will be. Now, the car is assumed to have a residual value of £5,000. Now, that's a big hint. That's a big hint that we're going to use straight line depreciation. Because interestingly, the question doesn't actually tell us that. So, oh, this is mean. Right. On the example I gave on the previous page, the depreciation, we just made a charge each year. But once in a while, you will see a question that says for every full month. So that means whatever the annual charge would be, that's going to be 1/12 of that. So let's have a look. So we've got 14,400. Our residual value is 5,000. So the cost over 5 years is going to be 9,400. So that over 4. Somebody's way ahead of me here, I think. Excellent. Yep. Well done, Sarah. Each year, 2350. Ooh. Now that's not a very very friendly figure. Which means divided by 12, we're going to get into a bit of rounding here. 195.83 a month. So purchased on the 1st of April. So year ended 31st of December 20x0, it's just December the first year. Now, ever so many people, me included, before I started doing it this way, will calculate the number of months wrong. So let's have a quick straw poll in the chat box if we can. April to December, how many months? Aha, this is good. We have two different answers. Right. Which is good. I'm glad, because this does vindicate that, if my pen will let me, here's what I do. There's the 1st of January. There's the 31st of December. We have January, February, March, April, May, June, July, August, September, October, November, December. And we bought it on the 1st of April. So here is the 1st of April. Now, how many months do we think? Given that there are 12 months in a year. Yes. Probably 30% of people who first work with monthly calculations, and you'll meet this a lot in any tax unit, will give an answer of 8 months for December to April, because our instinctive reaction is to say December 12, April 4, 12 less 4 is 8. So there's a tip. Draw that little line. It takes very little time, and you'll use that technique well, within this unit. At some point we will be talking about accruals and prepayments, and that is where you'll use that every single time if you take my advice. So it's 3/4 of a year then, isn't it? 9/12. So I wonder if, so times 9, what's that going to come round it? Aha. Okay. So sure enough, that figure times 9 gives us a nice neat figure after all. Now, I didn't round that 19195.83 recurring. I didn't round in my calculator. I left it as 0.833333, and that's why I've got the full 50 pence. So again, another tip is, as you try and structure your workings in a way where you leave figures unrounded in your calculator until you finish with them, and only round your very, very final answer if need be. Terrific. We're looking good. Now, so we're going to have a debit of 1762.50, and we're going to have a credit of 1762.50. That's not difficult, is it? Now, we have a pick list here where we have to choose. So we've got 1, 2, 3, we've got 5 items: depreciation expense, motor vehicles accumulated depreciation, bank, motor repairs, motor vehicles at cost. Now, with multi-choice, I always think the best thing is to spot the nonsense answers and eliminate those. So does depreciation involve paying someone to take the box of spanners and do some work on the vehicle? No, it doesn't. Wow, Zara's on fire tonight. I'm still going to go through the whys and the wherefores. Okay. Does the depreciation inspector come round with a big sack over his shoulder and say, I've come to collect the depreciation money? No. So there's nothing happens at the bank. Does the cost of an asset change? Just because it's now depreciated, did it cost you any different? No. So we're left with depreciation expense and motor vehicles accumulated depreciation. And as Zara has quite correctly pointed out, expense is always a debit. So we have depreciation expense is our debit, and then accumulated, excuse my abbreviations, but as you'll see, my pen doesn't like to be very helpful. Depreciation is our credit. So far, so good. Next bit of the question: are the following statements true or false? So if we are using non-current, the non-current asset register function in our accounts software, the depreciation, and interesting word here is not will always, or will, but the depreciation may be calculated and posted automatically. Well, it would make an awful lot of sense if it did, and in the majority of cases, sure enough. But again, the takeaway is if you see a question that says always, then be careful, because very few things in accounting or accounting software are always. Lots of things are usually, lots of things are sometimes, very few things are always, and very few things are never. So that can sometimes be a little bit of a warning word, because a lot more things may be true than are always definitely true. If the business is using the non-current asset register function in their account software, no further checks will need to be performed. So what do we mean by no further checks? Well, when the auditors come, they quite probably will want to wander around the car park and physically check that the cars that we've got listed are actually there. Having bought an asset and recorded it in our software, we may well need to check that an item is correct. So recording our non-current assets, there's more to it than simply writing it in the register and assuming it's correct. An interesting aside, obviously there's a dreadful tragedy unfolding in the world in Ukraine at the moment, but a major factor in the way the campaign has progressed from the Russian standpoint is they've had a huge amount of equipment failures. And a large part of the reason for that, I've been following a lot of economics and logistics channels on YouTube. One thing that doesn't happen with the military is there's very little check that items bought are what they are supposed to be. There's very little check that maintenance that's been carried out has been carried out. And the big takeaway that for me from something I saw over the weekend is that a non-current asset register is actually a major guard against fraud, because if we check that the assets are what they're supposed to be and they're in good order, so we will check condition as well, this is a major guard in every organization against corruption. So no further checks, and again, that's a bit of a never, isn't it? If ever we see you'll never need to, then that is very rarely correct. Finally, so if we're not using a function in our account software, instead we are using a separate register such as a spreadsheet, then a journal will need to be posted in the account software to manually enter the depreciation each year. To which I'd say, how else is it going to get there? So that's plainly, that one's true. You know, you just have to picture in your mind's eye, yep, we're doing it all in a spreadsheet. I've actually done a fixed asset register on a spreadsheet that wasn't a spreadsheet because spreadsheets weren't invented then. It was a big load of analysis paper where you penciled in each year your figures. It took a bit longer than a spreadsheet. Okay, so far so good. Let's have a look. What's the next bit of our exercise? Now here's non-current asset register. We actually did, anybody who wasn't here last week, we did make a start on this last week in that we did the acquisition of item A, which is the office furniture that was bought, office furniture on the 1st of March, and we paid, and because this is registered VAT, why did we check VAT for the answer to that question, we had to check the VAT because if we are not VAT registered, we pay out VAT. Everybody has to pay VAT to the supplier. If we are not VAT registered, we cannot claim it back. So we have to build it into the cost of the asset. We have to, effectively, the asset has cost us 20% more. As a VAT registered business, then we only record the net cost of the asset. So the answer is it affects the value of the asset that we must record, because we're not going to get it back. So it's part of what we are paying for our asset. And they paid in full in cash. So there we go. That's where we were up to. Now, our next job is to record any disposals. And here is the sale of a computer that is no longer required by the business. Now I've reproduced, good, okay. I've reproduced this data over the page to make life a bit simpler. So we bought this asset on the 5th of August X4. It cost us £8,000. Computer equipment is depreciated 3 years straight line basis. And this assumes a residual value of 25% of cost. So £8,000 times 25% means we expect this to be worth £2,000 at the end of its life. Our depreciable amount is therefore going to be £6,000. And we are depreciated over 3 years on a straight line basis, so we're simply going to divide that into 3 identical pieces of £2,000. Now, and here we go. Full year's depreciation is in the year of acquisition, none in the year of disposal. This is by far the most convenient way to do it, because if you think of the simple logistics of doing your depreciation, the fixed asset register lists all of the assets that you still own. If you've sold an asset, it's not there anymore. If you've just bought one 6 weeks ago, it's there. So by charging a full year's depreciation in the year of acquisition, it just means you depreciate everything that is on that register. You don't have to look back at, oh yes, look, there's one there we sold 6 months ago, we've got to charge that as well. It's so much simpler, and thankfully most of the time it's the way we do it. So we bought this 5.8 X4. Our year end, I think I haven't. Year end is 31st of August. So August 5th X4. So we can just do a little timeline here. It was bought 5th of August X4. There will then be depreciation on the 31st of August X4. Sold it in X6, there's going to be another year's depreciation, 31st of August X5, and then it is sold on the 5th of the 5th X6. So we've just got 2 lots of depreciation charged. Again, if you try and do it in your hand, we sold it 4X6, you know, there's a danger of thinking 4, 5, 6. If you do it this way, just walk through the life of the asset from the day it arrives through and each year end, there is a depreciation charge. So we know that that gives us our accumulated depreciation, therefore, of £4,000. We bought it for 8,000. So its net book value at the time we've disposed of it is 4,000. We've sold it for 3,500. So we should end up with a loss of 500. I use lots of paper, be it hard copy or electronic, for scribbling lots of workings on, and I strongly recommend doing that. So now let's see how this is reflected in the register. So the item that we have sold is this, which is this. So sure enough, here we can see the entries relating to the depreciation that's already there, and this one's actually, a lot of it's been done for us. We're not going to depreciate it year end 31/8x6. The reason being, we don't own it anymore. We only depreciate those assets that we still own. But what we have got is, during the course of the year, we have disposal proceeds. So we have received 3,500, and that was on the 5th of 5th x6. So if we want to trace the whole life cycle of this asset, we can see that it was bought. It was bought on the 5th of August. We've depreciated 1 year end, the second year end, and we've sold it there, and everything is back to zero. And all of these figures, of course, can be checked against our accounting entries in our main ledger for the same period of time. So that's done our disposal. Final job, depreciation for the year ended 31st of August 2086 for all of the assets remaining. Now, remind ourselves, fixtures and fittings are 25% reducing balance. You can see we have fixtures and fittings, our carrying amount, which we used to call the net book value. Now it's the carrying amount. We like to keep the language fresh, so people like me have to keep learning it anew. 4275 times 25%. So our charge for this year, 1068.75. 1068. Whoops. Try again. 1068.75. Okay. Which deducted from 4275, it is now worth 3206. The first time that ever happened was not a good experience. But thankfully, the undo button saves the day. And as per the graph when we talked right at the start, yeah, spot on, Carol, thank you. You see how the amount that's charged each year is diminishing. Each year we charge a bit less. Our server, which is a piece of computer equipment, I guess everybody probably knows now. When I grew up, your server brought you a cup of tea. Computer equipment is straight line, which means it's the same charge each year. So we don't actually have to work out what the charge is going to be for this, because it's the same asset as before. But we do have to 2.25 plus 6 work out how much of its value is left. 1350. Oh. Oh, and then the last bit, tiny bit short of room on the page. Wintersmith Company made a gain or loss of, well, we've already sort of worked this out using our common sense. Here is what it was worth. Here is what we got for it. we got less for it than it's worth, and the difference between the two, which we worked out in rough already, is 500. Now that task, as a matter of curiosity, would be over the 2 sessions. This would be about a half hour task, I think. Number of marks for the register. Either way. Okay, let's save that. And that concludes our session for this evening.